The concept of a mutual fund goes back to the 18th century, with the same goals in mind as their modern counterparts. Here's some background on the investment vehicle that made the stock market available to the ordinary person. The first mutual fund is said to have been created by a Dutch merchant known as Adrian van Ketwich in 1774. Its name, translated to English, was Unity Creates Strength. This fund is what is modernly known as a closed-end fund. The fund made 2,000 units available for purchase. Once all of the units were sold, the only way to invest in the fund was to buy units from an existing shareholder. This type of investment became popular throughout Europe in the late 1700s and 1800s, finally reaching America by 1893 with the inception of the Boston Personal Property Trust. The first modern mutual fund, the Massachusetts Investors Trust, was introduced in 1924. The difference between this fund and prior mutual funds was that this fund is what is known as an open-end fund, meaning the fund can continuously issue and redeem shares itself, as opposed to the closed-end funds of the past. This version of a mutual fund took off with investors, as the fund's assets grew over 600% in its first year. As times have changed, many different types of investment vehicles have been introduced. That being said, the fact that mutual funds haven't changed dramatically and are still widely used in our modern society speaks volumes to just how groundbreaking the idea of them was back in the 1700s.